Ladies and gentlemen, good day and welcome to Motilal Oswal Financial Services Limited Q4 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Manish Kayal. Thank you, and over to you, sir.
Thank you, Michelle. Good afternoon, everyone. I welcome all the participants on behalf of Motilal Oswal Financial Services Limited to take time out to attend our Q4 and full year FY26 earnings conference call. We hope that you had an opportunity to go through our investor deck and press release uploaded on the stock exchange and on our website yesterday. We have also uploaded the Excel data book which has all the operational and financial numbers. Please note that today's discussion may include some forward-looking statements. These forward-looking statements are based on our macro assessment and actual outcome may vary. We have the entire senior leadership management on the call. We will start this call with an opening remark by Naveen and will then have a Q&A session. Over to you, Naveen. Thank you.
Thank you, Manish, and good afternoon, everyone. A warm welcome to all of you to our earnings call for the quarter and the year ended March 2026. Starting with a broad backdrop, Motilal Oswal Financial Services is the largest integrated capital markets player with strong and rising rankings across businesses, a rising share of annuity revenues, and with each business still offering a strong growth runway. Since our listing back in 2007, we've never diluted our equity while consistently paying out dividends and executing 3 buybacks. This has only been possible due to our unique twin engine business model, wherein our large investment book serves as a strong backbone to all the operating businesses, which have seen rising needs of capital over the years due to changing regulations or strong growth in terms of the scale of the businesses. Our operating businesses have delivered a 10-year compounded operating profit after tax growth of 33% per annum, EPS growth of 28% per annum, return on equity of 23%. This strong growth is supported by our investment book, which grew by 40% compounded since inception, led by a combination of strong IRRs as well as reinvestment of the operating profits post distributions. Our annuity businesses now contribute over 60% of the revenues, have risen in the last 5 and 10 years, and our view will continue to rise going forward, resulting in improved quality as well as predictability of our cash flows. This growth is powered by future-ready tech infrastructure. We have embedded AI in every facet of business processes, improving internal productivity, strengthening execution, and creating a long-term strategic differentiation. We are now ranked among the top 150 companies based on the 2025 calendar year PAT and among top 200 companies by market cap. We see the next decade offering equally exciting prospects which should drive further improvement in these rankings. Context, the capital markets index is a rising part of NSE 500 index, and its share, the capital markets index share in the NSE 500 has grown from mere 0.13% 10 years ago to 0.84% 5 years ago, and now stands at over 2.5%. The number of companies in the capital market segment increased from just 3 10 years ago to 10 companies 5 years ago, and now at 18 companies. Motilal Oswal Financial Services has generated alpha for all its shareholders by delivering a 10-year return of 26% versus 17% for NSE 50 and 12% for NSE 500. Strong growth in India's total wealth from just over $10 trillion now to over $100 trillion in the centennial year of India. Financialization of these large wealth pool or savings and continued industry consolidation augur well for MOFSL in the decade that is ahead. Turning to FY26 performance, our FY26 continues to witness strength in most of the businesses. Growth has been, I repeat, led by annuity businesses, mainly asset management and private wealth. Our operating profit after tax in the year FY26 grew by 16% YOY to 2,360 crores, led by a 33% growth in the profits of asset and private wealth businesses. These businesses now contribute around 50% of the total operating profit, and we expect their share to continue to rise as these businesses continue to grow at a faster pace. Operating profit after tax for the fourth quarter grew by a strong 25% and also the strongest in the 4 quarters of the last financial year. We exit the last quarter with an operating PAT run rate of 661 crores. Our long-term credit rating was upgraded to AA+ with stable outlook. This is the highest rating ever granted to any non-bank domestic capital market player in India. Our total profit after taxes, including OCI, for the fourth quarter and the full year is impacted due to mark-to-market on our investment, which currently stands at around 9,000 crores. These are unrealized losses, and most of it has already been recouped in the month of April. The strong operating performance has been delivered in the backdrop of headwinded external environment, be it weak markets impacting mark-to-market in our AUM in multiple businesses, including asset management, private wealth, etc. This, coupled with multiple regulatory changes like the F&O changes, requirement of higher margins, etc., impacted market breadth. Also, FY26 was a year of investments on all fronts in the group, be it people, be it brand or technology. We've not left any stone unturned to maintain our leadership position in our businesses. Turning to segmental performance, asset and private wealth business comprises of the listed public equities at AMC, the private equity business, the real estate credit business, as well as the private wealth management business. Our asset management and private wealth businesses continued momentum during the year with robust net flows of 70,000 crores AUM, robust net flows of 70,000 crores and an AUM of 3.7 lakh crores, which is up by 34% year on year. The operating leverage from rising AUM has delivered stronger profit growth, and that should continue into the future. Starting with our asset management business, our AMC AUM crossed 1.5 lakh crores with diversified stream of active mutual funds, passive mutual funds, AIF and PMSs. Unique PAN catered by our AMC crossed 1 crore in March 26 versus 77 lakhs in March 25, which shows strong confidence by retail investors in our franchise. This is around 16% client share of all mutual fund investor base. The revival in the April month itself has propelled our average AUM to grow from 1.57 lakh crores of last year to 1.8 lakh crores now. Our product bouquet is very young, as significant flows comes only once product has crossed the 3-year track record. We launched 5 new mutual fund active products in FY26, increasing our presence now to 82% of the industry AUM. But importantly, only 6 of our funds have a vintage of over 3 years, versus 42, 29 and 26 funds with similar vintage in our top 3 peers in asset management business. We expect 8 funds to cross the 3-year vintage by March 27 for us and 16 funds by March 28. Some of these are best performing funds since inception in mainstream categories, and this should help strong flows as well as diversification of our AUM over the next 2 years. Our SIP flows in FY26 crossed 16,000 crore mark, up 78% year on year, with a market share of 4.7%, resulting in a SIP AUM of 30,000 crores as of March 26. Our latest AUM at 1.8 lakh crores is already 15% higher than our FY26 average of 1.57 lakh crores. AUM growth will also be supported by the strong 18,000 crore annualized SIP run rate. And as I mentioned earlier, more products crossing 3-year vintage and proposed collections from the NFOs in the pipeline should help the discretionary flows as well. We are growing via the GIFT City route, targeting inbound and outbound flows. To summarize, the AMC business will be an important growth and ARR driver for MOFSL on the back of 4 factors. Higher net flows market share than the AUM market share, improving market share in net flows led by greater number of products crossing 3-year vintage and launch of new products, SIP run rate of 1,500 crores, and potential mark-to-market after muted market returns for the last 2 years. Turning to the alternates or the private markets business, FY26 was eventful for our alternates business too. We raised our largest growth capital fund, IBAF5, raising close to $1 billion. This leads to a 40% growth in our fee accruing income from average AUM of 15,000 crores to a closing AUM of 21,000 crores. This AUM will be further supported by a strong launch pipeline with a maiden private credit fund of 3,000 crore rupees. The first commercial real estate credit fund that we hope to launch in the second half of this year, besides the launch of the Series 7 of the residential real estate credit fund. Alternates is a high focus segment for us, given the $1 trillion AUM in the developed market for just a market leader. We have a strong franchise in both capital and real estate and are confident to deliver industry-leading IRRs to our clients in all the products that we offer. With the recent launch of our private credit fund and the forthcoming launch of our commercial credit fund, we'll be offering a more comprehensive range of products in the alternates business, which is only seeing higher allocations both from the family offices as well as institutions. Here again, to summarize, the alternates asset management business will also be a key growth driver and an ARR driver for the group on the back of 3 factors. Larger fundraisers in every subsequent series. I would like to highlight that each of our growth capital funds have doubled in their size from the series 1 to 2 to 3 to 4 to 5. Entry into adjacencies and newer categories. And finally, more funds entering carry income recognition threshold, which will boost our carry income run rate from the current 250 crores per annum. The asset management business now contributes 33% of the group's operating profit after tax versus 26% in the last year. Turning to our private wealth management business, we've made large investments in senior leadership as well as RMs and will continue to do so in a calibrated manner for FY27 as well. Our focus is on growing the ARR AUM, which is currently at 46,000 crores, through various initiatives including advisory solutions, strengthening leverage solutions as a value add for UHNI clients, exclusive co-investments leveraging group synergy, etc. Our 440 plus RMs will also witness productivity improvement as 32% of them have a vintage of 3 plus years. All this will help in revenue growth along with cost to income improvement, driving profitability via operating leverage. Turning to our wealth management business, which comprises of retail broking, distribution, and our retail lending book, which generates NII. Led by a sharp focus on growing our distribution income and NII, our broking revenues in the wealth management business segment now stand at 35% of the full year revenues compared to 60% 5 years ago. Distribution book grew by 41% to nearly 41,000 crores as of March 26. We are confident that our distribution book will continue to grow meaningfully as we harness the cross-sell potential of our huge client base. Our loan book in this segment rose by over 30%, reaching 6,000 crores. Our MTF market share is close to 7% and has headroom to grow further. Our broking business continues to retain its leadership position as a full service broker. We are the largest broker in the cash segment on revenue market share. Our overall retail broking equity market share, including commodities, stood at 8.6% as of FY26. To summarize, for this business, we expect our ADTO market share to improve as the global uncertainty subsides, as we've also historically witnessed rising market shares with rising markets. The distribution and lending book will continue to drive growth and increase its share in MOFSL's ARR revenue pie. Turning now to our capital markets business, which includes both the institutional equities as well as the investment banking business. With a $5 trillion market cap and growing, there is a base level of IB activity that the markets will see every year. While there may be huge volatility quarter on quarter because of market conditions, We believe that despite all of this, our IB business has successfully 52 deals in FY26 with a cumulative raise of nearly 83,000 crores. And our fee income delivered a strong 39% growth to 309 crores. We are ranked number 2 in capital markets league table and number 1 in the QIP league table for FY26. In the institutional equities business, we aspire to take our coverage up from the current 360 to nearly 500 companies. We believe we have built a strong franchise and a diversified product portfolio. We have headroom to grow in some of the areas like advisory as well as M&A in the coming years. Our size per deal is materially higher than in the past, and with a strong deal pipeline, we believe this business is also poised for growth in the coming year. Turning to the housing finance business, we concluded another year of solid performance with disbursements rising by 28% to 2,300 crores, AUM rising by 25% to 6,100 crores. The housing finance business raised $100 million from ADB, validating the strong franchise. We expect the housing finance business, having formed a strong base and a very strong leadership team, to witness strong growth over the next 2-3 years. Business has a strong capital adequacy ratio, a low leverage, giving us enough growth levers without external equity capital dependency. To conclude, the rise in wealth of the nation to over $100 trillion, combined with financialization of savings, powerful tailwinds in terms of the rising weight of capital markets within the Indian market cap, all these augur well, for the group. In this space, Motilal Oswal's decadal track record of 33% compounded operating profit growth and an average ROE of 23%, entirely through internal accruals with no dilution, with rising market share in each businesses, entry into promising adjacencies in nearly each of our businesses, rising share of annuity revenues to over 60%, and finally improving quality and predictability of the cash flows driven by rising share of annuity revenues, all augur well. FY25 and FY26, these two financial years were marked by regulatory tightening combined with weak markets. Despite this, MOFSL delivered an operating PAT growth of 16% in the last year and 25% in the fourth quarter of last year. With regulatory headwinds in the base, continued resilience shown by Indian investors, the future outlook continues to look promising to us. With this, I conclude my opening remarks and open the floor for Q&A. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask questions may please press star and 1 on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may please press star and 1 to ask questions. The first question is from the line of Mehak from Emkay Global. Please go ahead.
Yeah, hi. Thank you for the opportunity. So I have a couple of questions. So first, with respect to the AMC business, right? So if we look at the SIP plus market share, it has dipped a bit during the quarter. So just wanted to know your thoughts on the same and what initiatives are basically being taken to regain that market share. Second would be on the revenue yields. So how should we look at the revenue yields going forward with respect to one, the regulatory change in terms of TER, and second, how are you looking at the alternate yields as well? Because if I look during the quarter, we have seen some bit of expansion in the yields. I think that would be largely on account of new funds which are being launched. So if you can clarify on that. And third question would be on the private wealth management segment. So if we see the lending assets have seen strong inflows during the quarter. So what has driven this growth in AUM and secondly the inflows also. So if you can just clarify on these things. Yeah.
Yeah, thanks for your questions. The first one was on SIP. So we are having a SIP run rate of 1,400 plus crores a month. There is a slight decline in that on two counts. One, our international funds are no longer able to take in new monies, and second, the microcap fund is also blocked. So that's the primary reason. And then yes, on the active side, we have seen a small drop in SIP. Now, SIP book growth is very, very linked to strong performance. As that comes back to us, especially in the main categories, you should again expect SIP books to climb. But as we speak, they are, at last year levels itself. Now, second, on fees, our fees as a consequence of the TER changes has continued to be unimpacted. In fact, slightly improved for our cohort of AUM per category. So that hasn't impacted us. On the alternate side also, our retention rates have been maintained. If at all you see a compression in margins for us, it is on account of mix effect. Our fastest growing part of business for last quarter, for example, was passives, where our retention is lower than actives, which is the second fastest growing part of our business, versus the alternates, where the growth was the slowest, but the yields are the highest. So the mix effect does result in some downward pressure.
Yeah, on the lending side in private wealth, as Naveen had mentioned, it's a stated strategy to provide solutions to ultra HNIs, family offices and HNIs to enhance yields. So basically it's a combination of lending against securities, lending against investment assets. And this basically contributes to growth in assets as well as ARR revenues.
Got it. I had one more last question with respect to the other expenses, which is the admin and the other expenses. So we have seen a sequential growth of around 20%. So I just wanted to understand whether it is some sort of marketing or investment engagement program related expense, or how, and particularly how should we look at it going forward in FY27?
Yeah. So quarter four includes predominant impact of higher marketing, brand promotion, and also the CSR expenses. So bulk of which have actually been incurred in the quarter four. So you will see the delta slightly higher on a sequential basis. However, for the full year, the overall other expenses are up by about 10% for the full financial year. Bulk of the other expenses includes marketing and tech, where we spend almost about 5.5% of our net revenues for this financial year FY26. So that's the larger impact of the other expenses.
Got it, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of Deep Vakil from Bandhan AMC. Please go ahead.
Hello. Thank you for the opportunity, sir. Am I audible?
Yes.
Yes, sir.
Sir, on a couple of questions. I mean, any guidance on the MTF book? I understand that we had around 6,500 crores of MTF book as of 9 months FY26, which has been slowed down to 5,700 crores as on March 26. So any strategic thing that we are thinking around this? I mean, I understand that our major lending, this is the major yield lending vehicle wherein, majorly debt is needed in this book itself. So any guidance, sir, on the MTF book and how are we looking at it in 27?
See, overall, if we look at our MTF book, that has actually grown for the full year at 40%, which is a strong surge, and our cash market share is also about, 7%, and MTF market share is also a replica of that. So we definitely have a very strong balance sheet to, grow this book. Over the last few years, if you look at, there has been a very strong growth of our MTF assets. And we expect, similar strong, growth to recur in the coming periods because we are the largest broker in terms of the cash brokerage revenue pie. And that is where we will carry an edge in terms of the higher growth for our MTF book.
Okay. And sir, any quarter-on-quarter impact, sir? Or it is a strategic move that you have taken in this quarter to reduce maybe on a quarterly basis and then again increase once market stabilizes?
No, it's more of, market impact, sequentially, more or less across the industry, the book is marginally lower. So it's a very marginal reduction. However, we're very confident of, growing this book.
Okay. And sir, any guidance on the broking income piece? Because I understand there was some degrowth in 26. But for 27, I understand once, market conditions stabilizes, volumes will return to normalcy. So any kind of number that you can put to broking revenues, over 27?
You're talking of the brokerage line item, right?
Yes, sir. Yes, broking income.
Yeah, broking revenue, see, if you look at, last entire financial year was, especially starting from Jan 25 to December, I would say that the revenues were lower, mainly because of the lower volumes and the impact of the, regulatory change, which had come on the F&O segment, especially, and also the lower overall cash volumes in the industry. However, if you look at, now quarter 4, again, the volumes have fully catched up, right? Our market share overall, ADTO market share is also up for the year by almost about 100 basis plus. So, quarter 4, if you look at the revenue growth is almost 33%, YOY. And again, the base is higher now because even moving to the, current financial year over last financial year, April over April is also, at a very higher base. So we expect, the brokerage line item to, decently catch up for the entire financial year, given that the regulatory impact is behind and the volumes have again catched up to the pre-regulatory change levels.
Sure, sir. One last thing, sir. On the MTM loss that we have had on the treasury book around 1,000 odd crores at console level. So, sir, my understanding is that, post March 30th, equities have rallied and as you mentioned in your PPT as well, majority of that loss has already been recouped. So, sir, that 1,000 crore loss is unrealized, right? We have not booked any realized, there's no realized impact, it's unrealized gain, correct? Unrealized loss.
Yes, this is a notional mark-to-market loss, which is, we have to revalue all our investments at mark-to-market based on the India's requirements. And that's why, these are notional losses, which we, we separately disclose across in terms of our operating performance and treasury performance. And as explained, most of these have been, recouped back in the April.
And just to add here, the long-term 10-year plus track record is that this investment book has, generated an IRR of 18%. Now this changes year to year because like you had the 31st March where there is a market drawdown, sometimes these compounded returns also look different, but longer term we've seen returns, at highs were as high as 19, at lows were as low as 15.5, but longer term we've seen the compounding at 18%. To that, when you add the post buyback in some years or post dividend free cash flows that are added to this book is actually compounded for the last 10 years at the rate of 40% per annum. And that is what I explained upfront in the con call remarks, that the rising capital needs of the businesses, both due to scale and regulations, have been internally funded on the back of this book. And you will see a lot of quarterly, depending on the market's volatility in this book, sometimes you may have unrealized gains, sometimes you may have unrealized losses. And that's why we separately call out the operating profit after tax number for each business so that there is no confusion about, this line item with the operating businesses.
Sure, sir. Thank you. All the best.
Just to add, all of these investments are actually collateralized with the lenders and serve as, very large lines available for the operating businesses of the firm. And, effectively the collateral is also expanding at the rate of 40% per annum.
Right, sir. Got it. Thank you.
Thank you.
Thank you. A reminder to all the participants that you may please press star and one to ask questions. The next question is from the line of Nidhesh Jain from Investec. Please go ahead.
Thanks for the opportunity. So first question is on asset management business. Is there any update on the investment team leadership in the investment and on the asset management side? Secondly, what is the guidance for net flows in the AMC business for FY27?
Yeah. Yes. So over the last period, you would be happy to know we have increased the team size on both the alternates and mutual fund in terms of managers and research. Overall, the investment team, inclusive of passive, is now over 50 members strong. As far as the leadership on the mutual fund side goes, we are evaluating both internal team members and external. We have a short list. We will take a decision soon. Now, in terms of net flows, last quarter's numbers, our net flows declined. Jan was the worst month for our active net flows. But in that month, passives, did very well, and overall we collected over 2,500 crores. Feb was when overall our numbers were weaker as the gold and silver ETF kind of a product flows normalized. As we speak into the for the last quarter, our net flow market share was lower than our AUM market share. But as we speak, the trends in April suggest that our net flow market share would be higher than our AUM market share.
So just to clarify, net flow, AMC, so mutual fund net flow market share may be higher than AUM market share for the month of April. Okay, that's good news. And secondly, so if you look at the capital market segment, we are seeing advent of digital brokers, and they are now impacting a lot of segments. We are seeing our market share declining in cash and F&O, but they are also equally becoming very strong distributors on the mutual fund side. So in that light, how are we planning our businesses from a longer term perspective, and how are we trying to build these businesses so that because what we see as a trend that customers definitely moving towards those platforms. And some of the numbers are quite glaring that 60-70% of the new SIPs are getting opened by these fintech platforms. So that has repercussion for all our businesses from a longer term perspective. And how are we thinking to build business in that light?
So when it comes to the overall wealth management business, which we are building on to, we have always been focusing on the research and advisory model. And if you look at our model, whether it is a franchisee segment, which is our biggest segment within the broking, and then the direct side, the PCG model and the branch model, we are very well aligned with our research and advisory led model along with the tech in the overall business. So what we have seen is that where we have focusing on the quality of the customer, where we can add value to the customer, and that is where we have been, as Naveen discussed, the overall cash market share on the revenue pie, we are very much higher, and we see that we can align our strategy towards that in a big way for the overall broking cum distribution model. So as you see, our overall wealth AUM has also been growing consistently and has grown 40% in the last year itself. As we talk, we are at around 44,000 crores. So that twin model is getting well aligned. At the same time, when you look at the discount model, we feel that the bigger traders are the proposition where the overall revenue pie gets aligned. So we are trying to see how we will try to align to the traders which take the bigger pie in the discount market. So how do we position ourselves for the bigger traders is something which we are also working up parallelly to take care of the overall market share from a market perspective.
Sure. That's it from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Dipanjan Ghosh from Citi. Please go ahead.
Hi. Good morning, everyone. A few questions from my side. First, on the private wealth business, if you were to look at your clientele base over the past 2-3 years versus, let's say, what it was, let's say, 5-6 years back, I just wanted to understand some sense of the clientele quality, both in terms of ticket size and in terms of occupation, business, domain of expertise, etc. If you can give some color on that or maybe quantify some of those cohorts. The second question is on the transactional revenues, ex of broking, in the private wealth and maybe to some extent on the wealth business also. How do you see the pipeline going into FY 2027, given the backdrop of whatever has been going on globally? And also, how do you really, kind of manage your risk prudence in this, when you kind of sign a deal for the transactional section versus, let's say, focus on fees? How do you really manage that? The third question is on the alternate segment. We are seeing some of the large asset management companies entering this segment in an aggressive manner, or at least from their commentary, it seems that they will be aggressive. Can you give some color on the white spaces in this segment? I mean, your pipeline is robust in terms of new players, but in terms of the white spaces in this segment, the supply side constraints, some of those, if you can give some color qualitatively. And lastly, one data keeping question, is there any guidance or expectation around carry income for FY 27 or 28?
Right. So I'm taking the private wealth question first. Essentially, the way to look at it is there are broadly 3 segments in private wealth. There is a HNI segment, which is broadly 5 to 100 crores. Then there is an ultra HNI segment, which is 100 plus. And then there are the family offices. So we operate in all 3 segments, and we put significant capabilities and resources to improve the value proposition in the ultra HNI and family office segment. Whereas in the HNI segment, we are increasing footprint by having presence in many more locations where we see high growth of HNIs. I think the best lead indicator to see the at least the headline quality of assets is the AUM per RM. If you see, the AUM per RM has been steadily increasing. A couple of years back, it was 300 crores, and right now it's about 450 crores. And this is on an increased base of RMs. So essentially, our penetration across segments is growing. And at the back end, and I'm just answering your second question, what we've done is we've significantly enhanced the product and investment capabilities within private wealth to cater to all these segments. So we have recruited people in equities, in alternates, in multi-asset solutions, as well as certain bespoke transaction strategies. The pipeline of transactions is very, very robust. What happens there is, whilst in the near term, the markets could be cyclical and that could impact a particular asset class. But essentially, right now, we have capabilities across asset classes. So there are private debt transactions where we are seeing a lot of flows from family offices. Similarly, early last year, we saw a lot of flows in unlisted equity transactions. So whilst the sentiment and the mood may impact flows into a particular asset class temporarily, however, given the multi-asset capabilities that we've built, the transaction capabilities are becoming much smoother on a quarter-on-quarter basis. Again, to answer your last question on due diligence, I think we draw a lot from the group capabilities. If you see, we've invested significantly at the group level as well to enhance capabilities in private credit on the real estate front, and we anyway have a very strong private equity capability. So coupled with the capabilities on the private wealth side in the investment team and the group capabilities, the underwriting process is very, very stringent and rigorous. So before deal would be taken to market or to clients, there is a lot of work that goes on before doing that.
Yeah. In terms of AMC, you asked about corporate carry income possibilities. Okay. The competition, as far as we are concerned, On the alternate side, we have gained market shares. We are amongst the top few in the industry with very distinct products with strong storylines, and I think a lot of our products are turning into brands, are being asked by the investors who are investing. So we have a very, very differentiated product basket. On top of it, there are unique products where we mix listed with unlisted. Not too many houses have the capability of running that kind of a product. Now, over and above the long-only investing in the alternate side, we also have quant-based investing. So there is a strategy where we have some significant amount of monies, which is now looking very, very strong. So overall, the alternate basket for us, we think is very, very relevant for investors. On the mutual fund side, we have expanded our product basket tremendously. So when a competition comes in, there is something which happens on year 1, there is something which happens after year 3. So we see as an industry higher traction after a fund crosses 3 years of existence. Now for us, from a 6 product basket, we are now over 17. As we speak, we have a fund launch going on, so the contra fund is on. Now, one by one, these products will start to complete 3 years. The first one would be a small cap fund, which completes 3 years in December. A large cap fund will do that next year in Jan, and every 2 months there will be a meaningful product which will complete 3 years. So we think in the next leg of growth versus the last one, our inflows will be way more diversified versus what we had.
As far as the variable additional returns is concerned, so we don't give out guidances. However, as explained in our last call, we have multiple number of funds which has reached in the last cohort of their life, which is last 3 years, where our IRRs are well above the hurdles, and that is the reason that we expect meaningful variable returns to accrue in the coming financial periods.
Got it. Maybe just one small follow-up on my first question. You are a boutique wealth manager which has gained scale over the years. Now, in terms of this increasing clients or kind of increasing presence in Alfa HNI and family offices, and your ability to kind of source large deals and execute large deals, I mean, what has changed in terms of how you're differentiating compared to, let's say, a small-scale wealth manager or some of the bank-based wealth outfits? I mean, what capabilities do you really have to kind of maintain or gain market share over medium to long term?
Yeah, so whilst our size has increased over time, our ambitions have never been boutique. And now the size is reflecting our ambition, but the runway for growth is much, much larger from here. But there are a lot of capabilities that help us, bring these boutique transactions to customers. So first is, if you look at the group level capabilities, we have businesses across capital market segments, whether it's alternatives, whether it's institutional equities, and we have significant skin in the game in all our products. So this allows us to source very proprietary transactions. Similarly, if you look at some of the group products, whether it is capabilities that we have created in private credit, whether the capabilities that we have built in private equity, and the investment that we have in research across these businesses, that again allows us to do due diligence on many transactions. We see many transactions, and that also helps us source transactions across asset classes, whether it is real estate, whether it is private credit, whether it is private equity. So I guess this should answer both your questions.
No, great. Thanks for the explanation and all the best.
On a lighter note, our leadership will be quite offended by the use of the word boutique for any of our businesses. But that's just on a lighter note. We have scale ambitions and leadership ambitions in every single business of ours.
No, I agree. I mean, the boutique word is more from the fact that, some of the wealth outfits have a banking license.
Thank you. The next question is from the line of Lalit Mohan Deo from Equirus Securities. Please go ahead.
Yeah, hi sir. Good afternoon. So just 2-3 questions. So firstly, on the mutual fund business side, so we have seen that our market share in that in MF flows have come down from around 7.5% to around 3%. So any particular channel where we have seen a decline in the flows, or is it like broadly across wealth channels over there? And while you have indicated that currently it is moving above our AUM market share, but so is it around the current levels, or is it have improved materially back to earlier levels? Second was on the private wealth management. This quarter we have added a material number of families over there, like more than 9,000. But also, could you give us more color, like on within this family count, like how much of these families will be there where we have a material relationship of more than 10 crores and where we can potentially increase further relationship over there? And lastly, from a 2-year perspective, like given the current business construct, how should we look at from a revenue perspective and for a profitable perspective across different segments? Like what could be the desired mix between different segments?
Okay, so I'll answer the third question first. As I explained to you, year after year, over the last 10 years, over the last 5 years, 3 years, and over the last year, FY25 also, our annuity stream of revenues have consistently gone up. They are now at over 60% of the total revenues. The asset management, alternates asset, private businesses as well as the private wealth businesses, share of profitability because of their annuity nature too have consistently gone up, and we see that a trend, as I called out, continuing to rise, including in FY27 over FY26. About your first question about the net flows in asset management market share decline channel-wise, we don't split that out channel-wise, but Prateek will still give you some color on the contraction in the net flow market share.
Yeah, to give you some color, we retained more or less, so the drop was there in gross flows as well. So we saw some bit, but that was small. We saw heightened redemption pressure in the month of Jan and Feb. It reduced in March, and it is actually below normal in April, and which is why our net share, we think, has again come back over AUM market share in April. Now, of the channels, we thought the wealth channel was where the pressure was the highest. Retail and digital channels held out much better.
I think on your quality of clients, just to give you some color, I mean, we work with 9,000 families, of which almost 50% are ultra HNI potential. And the scale of clients, quality of clients is steadily improving. And again, like I said, one of the headline numbers that you should look at that is, in spite of the denominator going up, which is the number of RMs, the AUM per RM has been steadily rising.
Sure, sir. And so just lastly, data.
Did we answer your questions?
Yes, sir. So just one last data keeping question. Like in the wealth business. Hello?
Yes, please proceed, sir.
Yes, sir. Thanks for the answer. Just one last data keeping question. So in the wealth business, we have seen, sir, some pickup in the TDR transactional income over there, transactional distribution income. So what would attribute to the same?
March quarter, typically the transaction income in the wealth business is higher because of the insurance distribution revenue. So quarter 4 is generally a seasonal, very large, insurance distribution business. So that is the delta coming out of the distribution revenues in quarter 4.
Thank you so much, sir. Ladies and gentlemen, we will take that as the last question for today. I now hand the conference over to the management for closing comments. Thank you, and over to you, sir.
On behalf of Motilal Oswal Financial Services, I thank every participant for attending the Q4 FY26 phone call. In case of any further queries, please do get in touch with our investor relations desk. Thank you and have a good day.
Thank you very much, sir. Thank you, members of the management. On behalf of Motilal Oswal Financial Services Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.